In 2026, the economy is telling two conflicting stories. The first is a story of unprecedented technological growth, a narrative of innovation and boundless potential that has propelled markets to dizzying new heights. The second is a story of structural exhaustion, a tale of aging infrastructure, persistent inflation, and the accumulated weight of years of easy money. The soft landing everyone promised in 2024 is hitting the hard reality of 2026. The disconnect between these two stories is becoming impossible to ignore. And now, a clear signal is cutting through the noise. The Sahm rule triggers. It's a simple, powerful recession indicator developed by economist Claudia Sahm. It triggers when the 3-month average unemployment rate rises by 0.5 percentage point above its 12-month low. The unemployment line crosses the 4.5% threshold. This isn't just another data point, it's a historical tripwire. Once crossed, it has an almost perfect track record of preceding a full-blown recession. We saw this pattern in 2001, after the dot-com bubble burst. We saw it in 2008, as the global financial crisis took hold. And again, during the unprecedented shock of 2020. For the average investor, reacting to headlines and price swings, this looks like a crisis. It's a moment of fear, a reason to sell everything and run for the hills. But for the strategist, this is a recalibration. It's not a crisis, but a clarification. The market is finally being forced to reprice risk, separating the resilient from the fragile. To protect and grow abundance in the coming hard landing, you must stop looking at price. Price is the noise, the emotional lagging indicator. Instead, start measuring what truly matters: resilience. This means digging deeper into the fundamentals. Look for cash flow durability, the ability to generate consistent income even in a downturn. Scrutinize balance sheet strength. Assess supply chain control and true pricing power, the capacity to raise prices without losing customers. These are the markers of an anti-fragile enterprise. The dominant story is no longer about volatility. It is about survival and strategic positioning. In this environment, positioning is oxygen. The moves you make now determine your ability to breathe through the downturn and thrive in the recovery. Protecting abundance in a hard landing starts now. Watch the signal, ignore the noise. 3 powerful forces are converging to reset the entire economic landscape. 3 forces are converging, each a harbinger of the Great Reset of 2026. 1. The yield curve steepening. 2. The AI CapEx air pocket. And 3. The energy bottleneck. These are the horsemen that will define the next cycle. History doesn't repeat, but it rhymes. The first horseman rides a familiar path. We are seeing the de-inversion trap. For months, an inverted yield curve signaled caution. But the real danger arrives when it steepens, as short-term rates fall faster than long-term rates. This isn't a sign of health. It's the market screaming that a recession is imminent. When the Fed cuts rates in 2026 to save the labor market, the engine has often already stalled. The cuts are not mercy. They're confirmation that the economic damage is done. This steepening compresses multiples. Why? Because the discount rate on future earnings becomes volatile and uncertain, forcing investors to reprice risk across the board. What was once valued on distant promise is now judged on immediate cash flow. Leverage gets tested first. Companies that borrowed heavily at low rates face a brutal refinancing cliff. Their survival becomes the market's first stress test. Then comes the second horseman, the AI CapEx air pocket. Billions were spent on hardware in 24 and 25, a capital expenditure cycle of historic proportions. The market priced in a revolution, but it forgot the lag between spending and earning. If the revenue from those chips, the actual profitable applications, doesn't hit the balance sheets by Q2 2026, the narrative breaks. The tech sector, the only thing holding up the S&P 500, could see a 20% valuation reset. The air pocket is the gap between hype and monetization. Utilization, not hype, will decide the winners. Metrics like inference cost per user and GPU active time will become the new gospel. Those who can't prove their return on invested capital will be punished. The third horseman is the energy bottleneck. The digital world is built on the physical one, and the AI boom has an insatiable thirst. Data centers drink power. Entire grids strain under the new concentrated demand. In places like Virginia or Arizona, the queue for new grid connections is measured in years, not months. Supply elasticity lags far behind these demand shocks. This exposes the critical difference between intermittent and baseload power. AI models train 24/7, they cannot run on hope. The intermittency of renewables widens risk bands for data center operators. Suddenly, baseload reliability reprices assets. Access to cheap, constant power becomes a primary determinant of a company's viability. Geography becomes destiny. Steepening, stalled monetization, and power constraints converge. Each force amplifies the others, creating a perfect storm that triggers a powerful rotation of capital. This reset is a transfer. From the over-leveraged and unprepared to those with strong balance sheets and foresight. From weak hands to strong, the task is to build the fortress before the shockwave hits. To do that, you need a blueprint. Now, the design. In an age of abundance threatened by instability, protection isn't about hiding in a bunker. It's about building a fortress, not a passive wall against the world, but an active, intelligent structure designed for resilience and strategic offense. This is the Fortress portfolio, built on a barbell framework. On one side, you have extreme safety, the shield. This is your defense against the storm, the bedrock of your financial structure. It's composed of the most reliable liquid assets, cash, gold, and treasuries. On the other side, you have precise, calculated aggression, the sword. This is your offense targeting specific, high-conviction growth themes with durable competitive advantages. Quality infrastructure, nuclear energy, and AI orchestrators. Let's deconstruct the shield. First, liquidity. In the landscape of 2026, cash is pure optionality. It is the power to act when others are paralyzed by fear or forced into liquidation. When asset prices are in freefall and credit markets seize, cash is the fuel you need to acquire quality assets at deep discounts. It is the ultimate tool for turning widespread panic into your personal pricing power. This dry powder is your tactical reserve. Second, gold. As global sovereign debt levels become mathematically unsustainable, faith in fiat currency will be tested. Gold remains the only universally recognized monetary asset that is not simultaneously someone else's liability. It is a shadow currency that doesn't rely on a government's promise, making it the ultimate insurance against systemic policy error. But its allocation must be disciplined. Sized, not oversized, a strategic hedge, not an all-in bet. And third, the yield lock. This is the final pillar of the shield, locking in yields of 4% or more in intermediate duration government bonds before the Federal Reserve inevitably crashes rates back towards zero is the ultimate defensive maneuver. Waiting for the crisis to hit is too late. By then, these yields will be gone. This move secures a reliable income stream while providing capital appreciation as rates fall. It is discipline over reach. Now for the sword. First, quality infrastructure. We're targeting assets with real predictable cash flows and regulated moats, toll roads, airports, data pipelines. These are the essential arteries of the modern economy, offering inflation protection and inelastic demand. Second, nuclear energy. As the world confronts the trilemma of energy security, affordability, and decarbonization, nuclear reemerges as the only viable solution for clean, reliable baseload power. The capital-heavy nature and regulatory complexity create immense barriers to entry, protecting incumbents. And third, AI orchestrators. We avoid the speculative frenzy of AI applications. Instead, we focus on the picks and shovels, the companies building the non-negotiable infrastructure of the AI revolution. Think advanced semiconductors, high-speed networking, and the power grid expansions required to run it all. They are the new compute utility. The fortress, then, is a barbell. Maximum protection on one end, precision offense on the other. It's a structure that thrives on volatility, not one that fears it. You don't predict the wave. You build the hull. Ready the capital. A hard landing in 2026 will be painful for the speculators. But for those with fortress balance sheets, zero debt, massive cash reserves, it is a generational buying opportunity. 1. Secure 12 to 24 months of liquidity. 2. Hedge 10% into physical assets. 3. Shift growth into energy and infrastructure. Process over prediction. Sizing over speculation. The goal is not just to survive 2026. The goal is to be the person standing with capital when the dust settles. Abundance isn't just what you have. It's what you keep when the world tries to take it back. Hold fast. Watch the signal. Ignore the noise. The landing is coming. Make sure you're in the right seat. Prepare.